do you know about music royalties? Virtually no one I know has ever spent a minute of time thinking about investing in artists, recording contracts, people who write the songs, people who record the songs. But you can do that now. You can actually buy a diversified basket, a catalog of different people's songs, both written and recorded, and get a regular, steady income stream from that. That's a great way to make a great additional, better wealth decision. And we'll be talking about that this week. This is Make Better Wealth Decisions, a podcast about financial blind spots, decision-making, and how the reality of higher rates, global tensions, and tariff instability impact your investments. I'm your host, John DeGuy, a portfolio manager with Design Securities in Toronto. This week on Make Better Wealth Decisions, we're speaking with David Vanka. David is the president, CFO, and portfolio manager for ICM Asset Management, which is a premier alternative management company for investing. He joined ICM as a partner in 2017 and is now serving as the lead manager on the ICM Crescendo Music Royalty Fund. He brings 30 years of experience in investment banking, trading, and capital markets to ICM, and over his career has served in a variety of capacities, including Vice President of Risk Management at Gluskin Sheff and Associates. David, how are you today?
I'm great. How are you, John?
Also great. It's wonderful having you on. And I wanted to begin by asking you to take a moment to just tell us a little bit about yourself.
Sure. I mean, my background is over 30 years in finance and investing. Grew up in BC, but moved to Calgary in the late 80s to go to school. And outside from a couple of years in the Cayman Islands, have been here ever since. And a lot of my career was based in the energy investment banking and trading space. Exited that around 2009, where we sold a business to an Australian bank. And for the last decade have been focused on private markets, private funds, and alternative asset classes. So what we do here is we run a number of portfolios. ICM's been around since 2003 and really just focused on the real assets. You know, real estate's a core component of our business in a separate pool. And music royalties has been an area where we're just on our 5-year anniversary of the fund. And continues to be a place where I spend the vast majority of my time.
So I've had other guests that have talked about real estate, but you, sir, are the first person I've come across that actually has some expertise with regard to music royalties. And it is such a niche that my suspicion is that most people listening won't even know what they are and never thought of them as being something that you could actually invest in as a retail investor. So what exactly are music royalties?
You're right. There's a smaller number of groups actively investing, but the asset itself has been around for a long time. So basically happens is somebody writes a song, Bob Dylan puts the words down on a piece of paper and writes some notes, and then somebody records the song, and it might be Bob Dylan or it might be somebody else. And those two things, the actual writing of the song and the recording of the song, effectively create copyrights. And what happens over time is to use those works, the owners of those rights have to be, compensated for what they've delivered. And the industry itself was in a tailspin. You think about the Napster days and the pirating and CDs. And in the pre-streaming era, the industry was really struggling. And since then, as we've seen quite a growth in streaming. So when you think about these two copyrights, again, one being the song that's written and one being the recording of the song, anytime they're played, a royalty is created. It could be streaming. It could be in a restaurant. It could be in a public performance. It could be in your video game. It could be on the radio. There's a lot of nuances to all of that. But just think of it as effectively the artist and the songwriter getting paid something along the way. And there's lots of complaints about less than penny per share that they earn, but they could certainly add up over time, particularly for the bigger artists and artists that are growing their career. So these royalties get collected and then they get distributed to the artist or the songwriter. So that's kind of how it works. And when you think about the retail investor, as you mentioned, or the private client investor, every one of them's got an interest in music and every one of their clients has an interest in music. So it becomes a really interesting discussion point as people start to add this into their portfolios as well.
I'll tell you a bit of a personal story. I grew up as a Queen fan.
Oh, yeah.
And I know they just sold their catalog a couple of years ago for over $1 billion. And I think it was the biggest sale of a catalog of music in the industry's history. But I have long been using a phrase, you will know the song, We Will Rock You. It was written by Brian May. And every time I'm at a sporting event, every time I'm anywhere and I hear We Will Rock You, I tell whoever's within earshot is that's another nickel for Brian.
Yep.
And That's the way I look at it. In his case, he was part of the band that recorded it, but he also wrote it. Just writing one song is the gift that keeps giving, it just pays you for the rest of your life. And it's one of those things that a lot of people don't really realize. If you can really hit it right, you can do really wonderful.
Yeah. Some of the recording artists that you think of from the band perspective, there's some of them that are actually more successful as songwriters. For example, there's a band called One Republic. The lead writer and frontman there is a guy named Ryan Tedder, and he sold his songwriting catalog for a few $100 million a number of years ago, which sort of dwarfs what he's doing with the band itself, even though they're quite a successful band. It's interesting for us, right? Like, for example, we acquired rights to NSYNC's Bye Bye Bye. And that's a song that's been not dormant, but it's been pretty steady for, 20, 30 years. Doesn't get a lot of press with newer listeners, but it's there performing. And then it shows up in the Wolverine Deadpool trailer. And all of a sudden it goes parabolically up in terms of the plays and the listens and everything else, and has a whole new audience just because of that inclusion in the video and the pop culture, similar to what we saw with Kate Bush a few years ago with Stranger Things. So you get these events that are, I think, upside surprises for us, but also, and some of them you can make happen, but some of them it's serendipity. But you also get an entirely new listener base where this generation, we can listen to anything and have access to anything. So it's like, where do you discover this music from going forward? The challenge for, I think, artists and writers is, there's so many songs that get uploaded. I think Spotify had a stat last year that it was about 2/3 to 3/4 of their songs had less than 10 plays. So it's not even like real music. So there's now this push to kind of crack down and eliminate a lot of that noise and really focus on the artists and producers themselves. So yeah.
Maybe we can talk about that. What types of royalties does your product ICM invest in? Is it performance? Is it mechanical? Is it a mix? And then similarly, what kind of artists? Is it country? Is it gospel? Is it rock? Is it new age? The cardinal rule of investing is to diversify. And I'm wondering if you can tell me a little bit about how a person who's investing in something which is as niche as music royalties might go about diversifying his portfolio of investments.
Yeah, that's where the fund concept comes in. I mean, they're difficult assets to acquire because they're all individual acquisitions with people who might be doing this once. So it's not like buying real estate where there's repeat transactions with all the people involved. So, I mean, the way you manage that is really having a portfolio of quite a few different artists or genres to help diversify that, just like you would with your stock portfolio. So we've acquired 35 catalogs to date over those 5 years, and we continue to be active buyers in the space. And with respect to genres, we look at all genres. I like to say we're agnostic. We're not totally agnostic. There's areas, for example, now where international music, certainly Latin's been really strong the last few years. African and Afrobeats music is quite strong. So there's growth in some of these emerging markets, emerging categories of music that you like to try and find assets in that space. But generally, you want to have a diversified portfolio. So what that means across genres, and genres all act differently. Country, for example, has quite a significant radio play. In hip hop, a large radio component is going to come off at some point. So you got to watch when you're looking at these catalogs where these royalties are coming from and where the risks are, and different genres behave differently. Certainly the types of royalties you mentioned, we like to acquire across both sides of those two copyrights I mentioned, the songwriter side and then the master sound recording. So when it comes to a songwriter, we could be buying off a writer or potentially music publisher, and there's different pieces of that pie. And, the advantage to that side is anytime it's recorded by somebody else, you still have the benefit of that. But we also like to buy on the master sound recording side, which is the songs themselves. And while each song is its own unique entity, it gets a larger proportion of streaming revenue than what the songwriters get. So, we'll get into the debate of how that should be balanced, but, we certainly like that trend. And that means we buy off the artists themselves. We can buy off a record label on occasion or step into those shoes. And we also have done some deals where we bought off a producer, or even in the case of Gordon Lightfoot and Janis Joplin, we bought off the estate of the former wife of the original manager of those two artists. He's also Bob Dylan's manager as well. A long, convoluted way to say there's different places we can go and there's different nuances to all these different royalties. But we want to be in a spot where if there's some regulatory change or some economic change that says more of the pie is going somewhere else, we just want to be balanced on that because you quite frankly, you can't predict where that's going to go.
seem to recall that not too long ago, you bought, I think, maybe the songwriting credits for the person who wrote Mariah Carey's All I Want for Christmas Is You.
Yeah, we bought a part of that. And that was, again, through sort of a family connection that happened, part of that family that happened there. And that's obviously, Christmas is a niche area. We also own Lauren Daigle's Christmas catalog. But that is a song that's been the number one Christmas song, is going to continue to play, continue to repeat. So very interesting for us for sure to be able to add that to the catalog as well. So yeah.
Here's my chance to say something positive about music royalties in general. I'm a portfolio manager. I'm trying to help people make better wealth decisions. And the number one rule of portfolio management or portfolio construction is to diversify within and throughout asset classes. So not only is music royalties something which is unique as an asset class, it's particularly unique and useful to my mind because the returns have been strong and stable, but perhaps even most importantly, they don't correlate to anything. Like there's no real reason that you should worry about whether the stock market is up or down or whether we have inflation or a recession. People are always going to stream. And as a result, the income stream associated with music royalties are really stable, predictable, and strong. I don't think it's a stretch to say high single digit returns are the sorts of things that you should be able to expect for as far as the eye can see.
Yep. I think that's right on the return standpoint and even potentially a little bit higher than that. What happens on the diversification benefits are huge. And, a lot of investors we talk to, they want to talk about the artists or the bands and things like that, which is great. People love the stories for sure. But when it comes to the portfolio construction, and this is why you saw some large pension funds being early on in this space, and all of them probably would if they could get enough access to it, is that if you take a chunk of this, and if people own equities, people own bonds, people own other alternative assets as well, what happens is in these disconnected times where we see these major events, like when COVID started, or even when tariffs were announced, I know it's rebounded. We'll see where all this settles out. But I mean, you sort of get drawdowns in all the asset classes at the same time. And music just kind of continues to perform the way it does because people are listening to it. And intuitively, there's no economic connection to what's going on. Sometimes in bad economies, people are listening to more. And where we kind of see the drivers of it is, streaming is 80% of the market in the US and, probably 60-ish worldwide. So streaming around the world is growing, but still has a ways to grow. We've been getting kind of the volume increase with more users, more subscribers, still growing at a nice clip. And we're also starting to see the price increase. And what that means is if Spotify, as an example, let's just call them the proxy for the industry, if they raise their prices, well, they'll keep their fee along the way, but that all flows down to the rights holders and people along the way. So, and they've just started that cycle of raising prices. And, it's a little bit analogous to what Netflix did when they got all the customers for $7.99, and now you're paying quite a bit more for that. So we think we're going to see this price cycle increase for a period of time. And those drivers are bigger than, and more related than anything that's certainly happening with the rest of your portfolio. So that's kind of what we like about it as well. Yeah.
It's as though you're building a moat around that portion of your business because it's the sort of thing that there's no real way to attack it. And I think economists would call inelasticity of demand. It doesn't really matter. People are always going to stream. Virtually no one who starts streaming stops. And if there's like a 90 some odd % retention rate, not only are they retained, but to your point, you're paying $7.99 this year, but $8.99 next year and $10.99 a couple years down the road. And before you know it, the same service is twice as profitable after 6 or 7 years because of steady incremental changes in the pricing, because it becomes something, it starts off as something that's nice to have. And for too long, it's seen as being a necessity. It's something that, we've all grown accustomed to listening to podcasts like this. Listen to the podcast on Spotify, it streams, and so it goes. Do you have any statistics on how streaming has been growing over the past number of years, or is it just sort of something that you would talk about anecdotally?
No, we're still growing. In the US is slowing a little bit, but we're still in that high single digits rate of growth. It was growing double digits for a while. And at some point you think it's saturated, but it hasn't quite yet. Rest of the world is growing in the teens. So, and some areas growing more than that. So we're starting to see that established around the world. And the other thing, more and more people don't talk about the population growth, but you get more and more people. Smartphones are continuing to proliferate. We take it for granted, but they're expanding in other parts of the world. And while for sure you pay less for Spotify in India than you do in the US, there's a lot of growth there that makes up for it. So yeah, it continues to grow. And, other areas of the market are as well. Like when you think about all the video content that's out there and even the gaming content as well, all of these use music and they have to license that music along the way. It may have slowed down a little bit when there was the writer's strike a couple of years ago, but generally that's an area where content is king. And as you described, your music bill is kind of like a utility bill. I mean, yeah, go to your family and see what happens when you cancel your music subscription. You're going to have a mutiny on your hands, right? Whereas video, because the content is more bespoke and specific, you have to own several different video services if you want to get it all. Then you might see a case of, well, if the economy is really tough, you might go from 6 video services to 3 or 2, whereas music, you generally have 1. Some might have 2, but they're usually purists and looking for something specific. But you can get 99% of what you want on any of these services. You can decide what works for you and what integrates with your family and your life and go from there. So it is really one of, I think, the last things that's going to be cut. And, an interesting exercise, I was at an event a little while ago that was related to this. And the concept is like, okay, put up your hand if you're going to cancel your subscription. If it goes up $1, $2, $5, $10, 50, nobody puts their hand up, right? So that's where it's kind of going, I think, with this. And that sort of benefits the space itself. And I think in addition to the diversification benefits, you do have industry growth like we have talked about. Again, this isn't a strategy where you're going to make 10 times your money. It plugs away, continues to grow, and it just provides that, as you said, diversification and a lack of correlation to really the other assets that you own.
Is there anything you can tell me without giving away any secrets with regard to the special sauce about your investing process? Specifically, what I'm looking for is maybe one example of one thing that you definitely look for when you're going to buy a catalog or a royalty stream, and one thing that you certainly want to avoid and when you're considering what you might want to get into.
Yeah, they might be tied to the same thing. So we want to avoid extremely new music where we can't, I'll say predict, but we can't estimate with confidence where that's actually going to stabilize. So if a song is, being promoted very heavily for the first couple of years of its life, it'll eventually slow down. It'll come off that promotion cycle. It'll lose its initial radio play, and then it'll find some level of stability over time. And that's kind of where we look. And catalogs in sort of a 5 to 10 years old range are interesting because you could get pricing that's better than your Queen catalog as an example, but you still are in a spot you're starting to see these catalogs perform in a certain way. And if the artists are active, that helps us a lot. So we're not trying to pick music that we like, although that's really nice if we can. But if the artist continues to be active, they're listening, their audience is growing, they're going on tour, that helps a lot. Collaborating with other artists help a lot. So we see that activity in the newer artists, that really can help as well. And then the super iconic, very established artist, sometimes they're trading at prices that are beyond what we could meet our investment outcome, unless you've got the whole tide. And I think even the buyers who are paying pretty high multiples of cash flow are still going to do well over time, but it becomes a different sort of risk scenario. So we're kind of looking for catalogs where when we go through our investment process, we break down, okay, where is the revenue coming from? And, it's a little more than like what's streaming and what's radio and they call it sync licensing when you put it into videos, but then getting a little bit more granular about that. And then we just try and make some assumptions of how it's going to grow or decay over time based on the catalog. And if there's any other nuances or things that can be done to help improve the value of it over time. So that's sort of the starting point. And then we look at, acquisitions. You have to deal with what's available. It's not very effective to just go to the artist and say, do you want to sell? Because it takes them a long time if they haven't thought about that. So it's better to work with people who are already in that thought process. And then what we need to do now is say, okay, how does that fit into the overall portfolio? So when we first started, you're building it up. And now that we've got a bigger portfolio, how does this fit in the overall portfolio? Are there any areas within there we're concerned or interested about? And then build it from there. So that's where we look at. And we do hunt a little bit for some of the genres as an example that we think are growing. Like again, Latin's a great example where we've done 2 catalogs, and those are things that matter. And then the weeds on the due diligence, I mean, it's helpful for us to have good contracts in place, counterparties who are confident are going to pay us is kind of an important thing. And it sounds like it's common sense, but you do start looking at some of these catalogs, and maybe it's stereotyping genres, but in hip hop or some of the developing country ones, I mean, you may get some gaps in this where we need to kind of fix it over time. So it's kind of really digging into the weeds on all that going forward.
So I think it would be worthwhile just to take a moment to paint a broad picture to put this all into perspective as we get ready to wrap up here. Products such as yours are offered through a structure called an offering memorandum. It's not a mutual fund or a stock or an exchange traded fund. It's an offering memorandum product, which means it's only available to accredited investors. And I think people who have been watching Make Better Wealth Decisions by now should know that an OM is only available to accredited investors. Accredited investors is $200,000 of income of yourself, $300,000 with you or your spouse, or $150,000 invested, no questions asked, or $1 million of net liquid assets. Those are the main tests of what constitutes an accredited investor. But the other way that you can get access to a product such as yours is to work through a portfolio manager, because the portfolio manager has a fiduciary obligation. And then even if you're not earning that kind of money or anything like that, you can still get access to what I think is an excellent product. And one of the great benefits of working with the portfolio manager is it broadens the product shelf and gets really good products available to ordinary people who otherwise would not have access to them. Now, there are risks. Liquidity, it's the nature of, having the ability to give people their money back if they put a sell order in. It could take some time. I'm trying to think of what the actual downside of investing in music royalties. And I don't think liquidity or moderate illiquidity is a big problem. But what's the time frame? If someone put a trade order in on, say, the first week of July, how long would it take them before they could get their money out?
Yeah, I mean, today we'd have that within the next month. I mean, there's limits to how much that we can do on the liquidity side, but certainly we meet all redemptions that we can meet, even excess of those limits. If everybody came at the same time and we said, okay, everybody wants their money back, we'd wind it down. We would go through an orderly process of selling the assets either on block or piecemeal. And you would start seeing, some money back in a few months, some in 6 months, maybe the last piece in a year, depending on, how we pace that out. This asset's a little different than some other private assets. So when we actually make an acquisition, we start generating cash for our investors almost immediately. We don't have a J curve, if your investors are familiar with that, like we would in development real estate or even, private equity where you've got an operating business. So that's something that certainly adds to the liquidity. And that's not really a big concern to us at all. And if you don't own a portfolio of catalogs, certainly people listening less than expected to a catalog is going to reduce the performance over time. But again, these assets, because you generate revenue on the top line, you don't have a big cost structure underneath if you went and bought a private business where you've got operating capacities you have to deal with in good years and bad years. Really, it can just be a longer payout and a lower IRR on any individual assets. It's definitely reliant on the streaming providers to continue streaming. We don't think that business is going anywhere, but obviously a big chunk of it is being consumed through streaming services. And what they're doing is going to impact that. And, we're at a spot where, if anything, this pie is growing, not shrinking. So that's a positive, I think, for the industry itself.
All right, let's see if we can wrap this up, David. If it was up to you, what advice would you give listeners to actually help them make better wealth decisions?
If you're a listener who's just sitting on sort of a traditional, call it 60-40 portfolio, and I think at any phase of your life, I think you want to take a little broader look at what your long-term goals and needs are and fit your portfolio to that. And that's where I think alternative investments in general could certainly be a nice, more than a buffer. Some can certainly enhance returns, but some can create those diversification benefits to it. So I would look at something like music really, almost across the investor class and say, if it's a 5% or 10% weight or something in the middle to that is appropriate for a lot of people. It's certainly appropriate for people who need the income and the cash flow over time, that diversification. I call it risk buffering. And it's definitely appropriate for early investors who say, same thing, I want this benefit over time. Plus, I've got some emotional connection to what I'm doing and I'm actually interested in it. And I can impress my friends and kids around the kitchen table. So there you go.
David, thank you so much for your time today. It's been a pleasure. It's great getting to know you, and I want to wish you all the best down the road.
Thanks, John, and congratulations for such a great podcast you've been doing. I really appreciate it. So thank you for the time.
This podcast is not to be construed as offering specific investment advice. Please consult a qualified advisor before acting. My books, Stand Up to the Financial Services Industry and Bullshift, are available online. If you'd like to meet to discuss how the topics in this podcast affect you directly, please visit my website.